Un, deux, vous m'entendez? Bonjour à tous. Donc on va commencer maintenant. Je vais faire en anglais. So it's a great pleasure to have here with us Mr. Guy Kawasaki. So thanks so much for accepting our invitation here. So you have a group of roughly 200 students from many schools. A few words to thank everybody that made that possible. So the éditions Diateno, SchooLab, Numa, and all the people that help us to make it happen. It's a real honor. We used to actually I used your book when I was a student, when I was a really early stage entrepreneur. So I use it, and since 10 years for the CPI program, we used to give your books as one of the gifts at the end of the class for the students, for inspiring them and giving them the desire to become an entrepreneur. So my pleasure to welcome you here, guys. Hope you have a great time in Paris. So we planned about 1 hour for you on stage, and then some Q&A after for the students. It's live stream on YouTube and Google+. For those who wants to ask a question during the session, we'll take also some of the online session. So, Guy, please welcome Guy Kawasaki.
Thank you. Good morning. Thank you very much for this opportunity to speak here. I'm actually here for Le Web, and I spoke there yesterday, and I'm going to speak here today. And the rest of the time I'm going to play in Paris. So I haven't come to Paris too many times in my life. I truly do love your city. And I happen to be, usually when I come to Paris, I'm with my wife, which is a rare occasion that I travel with my wife. And actually last time I was here with my wife and daughter, which cost me 2 times as much as just traveling with my wife. That's a whole other story. So I'll give you a little bit of my background. I used to work for Apple. I was Apple's software evangelist. So my job was to convince people to write Macintosh software. That was the first time I worked for Apple. The second time I worked for Apple, I was Apple's chief evangelist. This was way back in 1997, 1996. I hope you guys were born then. Barely. And after that, I started a software company. After I left Apple the first time, I started a software company with some French people. It was called ACI. It had a Macintosh relational database called Fourth Dimension. And so that started my, my familiarity with France and Paris and French people and French programmers. After I returned to Apple the second time as chief evangelist, I left that to start a Garage.com, which is a boutique investment bank and venture capital firm. And now I'm primarily a writer and a speaker, and I also advise Motorola. So for Motorola, I work with the CEO. We just introduced a new phone in Europe called the Moto G, which is a sub $200 phone. The design goal for the Moto G is to be almost as good as an iPhone 5 at 1/3 the price. It's $200 off contract. So a very different price point in much of the world. And that's my background. I've written 12 books, some of which you see at the back table in French. My French publisher is here. And I will be happy to talk about those books. My latest book is a book called Ape, which is author, publisher, entrepreneur. It explains how to self-publish a book. And today's topic I chose as the top 10 mistakes of entrepreneurs. I will go over what I see as the top 10 mistakes of entrepreneurs and how to prevent them. And so I hope that if nothing else, you will not repeat the same mistakes that other entrepreneurs make. So please make different mistakes, at least. And this speech I've given, a handful of times, not that many times. And mostly to schools, in particular the Haas School of UC Berkeley. And I truly enjoy this speech. So, okay? Can I begin? Yeah? Ready to go? Okay. So first of all, I always use a top 10 format. This is because I've seen so many tech speakers in my career, and most of them suck as speakers. And they not only suck, they go long. And that's a bad combination. Tip number 1 for you. If you suck as a speaker, try to go short. So tech speakers in general, they suck and go long. And it's not so bad if you suck and you go short, It's not so bad if you're great and you go long, but if you suck and go long, that's a really stupid combination. That is like being stupid and arrogant at the same time. So what I do is I use a top 10 format so that in case anybody thinks I suck, they know approximately how much longer I'll suck because I have exactly 10 points in this presentation. Okay? So point number one is I meet with entrepreneurs all the time, and they create a financial forecast. And what they do is they multiply a really big number by a small number, and they get a big number. To use a classic example from Silicon Valley, let's do the analysis of this with pets.com. Okay, so this is a 10 or 15 years ago company. So pets.com, here was the thinking. There are 300 million Americans. 1 in 4 owns a dog. That's 75 million dogs. Each dog eats 2 cans of dog food per day. That's 150 million cans of dog food per day. How hard could it be for our company with our rock star programmers to get a mere 1% of 150 million cans of dog food per day eaten in the United States? 1% of 150 million is 1.5 million. Let's say we make $1 per can. So conservatively speaking, we should be able to make, $1.5 million a day. Let's be even more conservative. Let's cut that in half. Let's say we make $750,000 a day. So you take $750,000 and you multiply by 365 because dogs eat 365 days a year. It's not like B2B. This is, this is cow to canine. I mean, it's C2C business, right? So you take 750,000 and you multiply by 365 and you get a $300 million business. Worst case, conservatively speaking, first year. So we hear this kind of forecast every day. Every day. No one ever comes in and says we have a crappy market that doesn't have a lot of upside. Everybody has a great market. And what I see done is the reasoning that I just went through. That reasoning has some bad ramifications. One ramification is typically you inflate the expectation of your investors and your employees because you're saying, how hard could it be? Conservatively speaking, we'll do $750,000 a day times 365, $250, $300 million business. That's the worst case first year revenue. Okay, the likelihood of you getting $300 million in your first year is zero. Zero. No company's ever done that. So that's number one. And number two, the offshoot of this reasoning is, well, conservatively speaking, we're going to do $300 million a year. That means we need a lot of infrastructure. We're going to need at least our site to be mirrored in 2 or 3 places because God knows if anybody comes to our site and wants to buy dog food and our dog food site is down, it'll ruin our reputation. So we need to have our site, mirrored in a couple places. We need IT staff. And if people have problems ordering dog food online, they need to have great support. So now we need to hire a customer service infrastructure so that we can answer questions in real time about buying dog food. And so what happens is you do this conservative estimate of $300 million. You figure, well, I'm going to need at least 2 or 3 locations, and I'm going to need at least 30 or 40 people to handle the hundreds of calls we're going to get in every day. And so you do this, and next thing you know, you have a monthly infrastructure costs, overhead costs of about $200,000-$300,000. So now you're spending $200,000 or $300,000 a month because you're anticipating a $300 million business of selling dog food. Of course, your rockstar programmers are at least a year late because every programmer is always a year late, right? So now you have all these customer service people, you have these IT people, you have this entire infrastructure, you have this entire overhead, and you're not selling anything because your site is not ready. Okay? So this goes on, your programmers are late, you go to your board of directors, you tell them you're late, they're not surprised because every investment they've made is late. So they kind of look the other way, they kind of laugh the first time. And then you convince them that, wow, we hired these really great customer service people. We hired these really great IT people. And we know our programmers will be on time the next time. So it would be foolish to take these world-class customer service people and these world-class IT people and get rid of them now, because in 60 days we're going to have to hire all new people and retrain them again. So we need to sustain that investment. Well, guess what? So you keep those people, you don't lay them off, you don't lower your overhead, and then the programmers are late again. And this is what happens all the time. You know, the leading cause of failure in Silicon Valley startups is running out of money. It's, you know, the leading cause of failure is death, which sounds somewhat like a circular reasoning, but if you think about it, that's really true. The leading reason for failure in tech companies is death, which is running out of money. So this is the mistake, to multiply a big number by a small number to get a still big number. The way you fix that is you calculate from the bottom up, which means that instead of you doing 300 million Americans, 75 million dogs, 2 cans of dog food per day, total addressable market of 150 million cans of dog food per day, you do it from the bottom up. You say, okay, so how many unique people could possibly come to our website in a month of our new website, you know, easydogfood.com? And you, in your wildest hallucinations, you'd say, okay, so maybe 100,000 people will come to our website. So you take 100,000, then you say, like, of that 100,000 people, what percentage might actually buy dog food from us? So let's be conservative. Let's say it's 1%. So 1% of 100,000 people is 1,000 people. So 1,000 people actually buy dog food. The 1,000 people, let's be, again, you know, cautiously optimistic. Let's say those 1,000 people buy a case of dog food a month, right? 30 cans, 30 days. So 30 cans, 30 days. So that's 1,000 people buying one case, which is 30 cans. So it's 1,000 times 30. So that's 30,000 cans of dog food a month. 30,000 cans of dog food a month done from the bottom up is a lot less than 1.5 million cans a day times 1. Well, that is 1%. So if you took 1.5 million cans of dog food per day, multiplied it by 30, compared to 30,000 cans of dog food a month, and the reality is that you're going to be much closer to selling 30,000 cans of dog food in the month than 45 million. Trust me when I tell you this. So I think the best way you can fix this problem is always do your financial projections from the bottom up, not from the top down. Don't take a big number, total addressable market, and keep multiplying it down until you still have a big number. Start from the very bottom. How many, if you're doing a retail operation, you know, how many stores could you possibly open up? How many restaurants could you open up? How many people could come to a website? How many, if you're doing a car service, you know, how many cars could you possibly deploy on the road? Forget that, you know, the total addressable market for taxis in Paris is 2 billion euros a year. If you only got 1% of 2 billion euros, you know how big our taxi cab company would be. How many Mercedes can you lease in a month? How many drivers can you deploy in a month? Do a bottom-up analysis. That's mistake number 1 that I see all the time. Mistake number 2 is to scale too fast. This is the offshoot of mistake number 1. So we're going to have 1.5 million cans of dog food per day. We need several sites. We need 30, 50 customer service people. And companies, entrepreneurs like to hire in advance because they're so confident in their rock star programmers. They're so confident it's going to happen. And they have a lot of overhead for nothing. The solution to this is what we say in America is to eat what you kill, which is when you get the sale, then you worry about scaling to service it. Don't be so optimistic as to think we're going to do $300 million this year. We need to scale for that in advance. Let me tell you something. If you have $300 million in sales, you will figure out a way to scale. You can do it in real time. You can do it even late, but never do it early. I have never seen a company say we're going to do $300 million, we're going to staff up for $300 million business, and actually achieve $300 million business, okay? So eat what you kill. Mistake number 3 is to focus on forming partnerships. I don't know the sort of linguistics here in France, but in America, Lots of entrepreneurs throw the word partnership around, and what it translates to in most cases is lack of business model. So if you can't figure out a business model to make money for mutual benefit of multiple companies, you say we form a partnership. In other words, it's total bullshit. Okay? Don't focus on partnerships. Partnerships are bullshit. I learned this working with Apple, because Apple would form all these partnerships with companies. And the perspective of Apple was, well, we have a weakness and you have a weakness, so maybe we can form a partnership and both hide each other's weaknesses. If you ever start thinking like that, you know you're doomed. Okay? A great partnership works when two companies have great strengths. And you're not trying to cover weaknesses. You're trying to enlarge, expand, accelerate strengths. So there's a very big difference between covering weaknesses versus expanding strengths. The solution to this is to always focus on sales. My recommendation for entrepreneurs is very simple. Sales fixes everything. Seriously, sales fixes everything. Every problem you have will be fixed by sales. It's easier to recruit when you have sales. It's easier to get investment when you have sales. It's easier to get up in the morning when you have sales. Everything is fixed by sales. Now, some of you are going to say, well, what about profit? You know, can we get a little more sophisticated in reasoning? The answer to that is probably yes. But at the end of the day, man, as long as you're selling, you have cash coming in, you're in the game. And as long as you have cash coming in, you're not going to die. And as long as you're not dying, you still have a chance. When you have to deal with your investors, and you will be dealing with your investors, you know, they're on 10 different boards, and of the 10, 9 of them are below their forecasts. They're below their conservative forecasts. Okay, so you want to be the one exception that is equal or greater than the conservative forecast. If I leave you with no other message, sales fixes everything. Next problem. Next problem is to focus on the pitch. I meet so many entrepreneurs, and they're obsessed with the quality of their pitch. They want to make it this 60-slide, just, you know, work of art. And nothing could be worse than that. You know, the purpose of creating a pitch is that it's a means to an end. And the end is financing. But I give you a better means to an end. The better way to get financing is to, A, never need financing because you're bootstrapping your company. The way you bootstrap your company is you focus on the prototype. I mean, you actually ship quickly. I think today the startup atmosphere is so different from 10 or 15 years ago. 10 or 15 years ago, you had to raise a couple $1 million. You had to buy tools. You had to buy physical space or rent physical space. You had to buy servers. You had to build co-location. You had to do all these kind of things. Okay, fast forward till today. You know, open source, every tool is free or cheap. Marketing is free or cheap. You use Twitter, Facebook, Google+, whatever it is. Use social media for your marketing. Do you have to have office space anymore? Not as much. I mean, you come into facilities like this, you share office space. You don't need to get your own office. Do you need to buy servers? Not at all, right? Everything is rack space or Amazon S3 or, you know, whatever French equivalent there is of that. Nobody buys a server anymore. You send $1,000 a month to Jeff Bezos and you get a terabyte in the sky. Right? So it's very, very different. So if you go down the list of all the things you need money for, do you need real estate money? No. Do you need tools money? No. Do you need marketing money? No. It takes a lot less money to start a company. So now, if it takes a lot less money to start a company, guess what? You don't need to focus on the pitch. You don't need to suck up the venture capitalists. You should think of venture capitalists as drug dealers. Okay? So drug dealers give you a temporary high. They want you to get addicted. But eventually, it's going to kill you. I'm telling you now, venture capital is like crack. You need to postpone taking crack as long as possible. Hopefully never take crack. Is there venture capitalists in this audience? No, not beside me. I'm reformed. So seriously, you should really try to avoid venture capital. Focus on the prototype. Get it out. Number 5, Number 5 is in this presentation that you're working on, if I haven't dissuaded you enough, you put too many slides. In Silicon Valley, we call this an elevator pitch. And is there an elevator in this building? I know we walked up 4 floors. There isn't an elevator, right? Okay, so the test for this is if you're walking up that stairway with someone and you're trying to explain their company, your company, you should be able to explain it in 2 floors. Okay, so not that you're in the Transamerica Tower and it's like 105 floors or the Sears Tower. It should be 2 floors here if you're walking, right? So it's 30 seconds. In a pitch, my rule for a pitch is the 10-20-30 rule. So the 10-20-30 rule is that the optimal number of slides in a presentation is 10. You should be able to give those 10 slides in 20 minutes. You may have a 1-hour meeting, but many people still use Windows laptops, and those people need 40 minutes to make it work with the projector. Okay? If everybody used the Macintosh, you'd all have 60 minutes. So how many of you don't use a Macintosh in this room? So these are the people. You're going to need 40 minutes to make it work with the projector. Okay, so that's why. If everybody used a Macintosh, this rule would be the 10-60-30 rule. Okay, but lots of people still use Windows laptops and they can't make it work with the projector. So I had to dumb this rule down. Okay, so the 30 is the font size. The optimal size font for presentation is 30 points. The bigger the font, the better. Steve Jobs used like 150-point font. Okay. The problem with using a small font is the temptation to put too much text. When you put too much text, it's not readable to the audience, but you will read it to the audience. And I think what happens is when you start reading your presentation to the audience, you lose the audience because the audience very shortly figures out this clown is reading the slides to me. And so I can read silently to myself faster than this clown can read them to me. I'll just read ahead. What do I need to listen to him for? And you lose your audience. A good rule of thumb for this is figure out who the oldest person is in your audience, divide his or her age by 2. So if you're speaking to 60-year-old people, 30-point font. 50-year-old people, 25-point font. Someday you may be pitching a 16-year-old VC, okay? That day, 8-point font. But until that day, 10 slides, 20 minutes, 30 points. Number 6. Number 6 is this mistake of trying to make serial progress, which is to say, I as an entrepreneur, I want to do things in a serial manner. First, I want to raise money quickly. Then I will get the money and I will hire people. And then we will focus on making the product. And then we will focus on selling the product. And then we'll focus on collecting the money. And then we'll focus on revising the product. And then we'll focus on selling more product. And then we'll focus on collecting more money. So entrepreneurs, like authors, would like to do things in a serial way. An author would like to write the book, edit the book, publish the book, sell the book. Okay? And I can tell you, as an author and as an entrepreneur, life is simply not serial. Life is parallel. And so as an entrepreneur, you're going to have to raise money, recruit, make your prototype, sell your prototype, fix your prototype, collect money at the same time. You're going to be moving 5 or 6 challenges down the road at the same time. Life is not fair. It's not going to work where you think, I'm going to focus on raising money. That's all I'm going to do. I'm going to do that in 30 days so I can get to the real business of my business, which is writing software. It's not going to work like that. Raising money, at least in Silicon Valley, is a 6 to 12-month process. And if you did nothing for the 6 months but raise money and then start writing your software, you are starting a year or half a year late. Okay? So you have to come to the realization that as an entrepreneur, you have to move all these things down the road at once. As an author, I need to write my book. I need to be editing what I've just written. I need to be building my social media platform. I need to be thinking about the design of the book. I need to be thinking about the marketing of the book and the distribution of the book all at the same time. Life is not fair. Life is parallel. It's not serial. Number 7. I just noticed this wire thing. That is so cool. Huh? Who made that? That is so cool. God, French people. French people. I've never seen something that cool. That's so cool. Can I take that with me? Or just leave it there. And I'll always come back. Put that in the Louvre. Number 7. is the mistake of trying to retain control. And in a sense, this comes back to the quantitative nature of tech startups, which means that it's usually founded by engineers. And engineers are good in math. So engineering and math says that if you own more than 50% of a company, you control the company. So the key to the control of a company is retaining 50% or more. Mathematically, that is true. But emotionally and realistically, that is not true. The moment you take money from outside investors, you are working for outside investors. It doesn't matter if you still control 50% or more of the company. You are not in control. Yeah, I have never gone to a board meeting where any issue was decided by a vote. I've never seen a vote, let's hire this person. 51-49, founders carried the day. Let's go into this market. 51-49, founders win. You never vote like that. Everything is always unanimous. You're all right or you're all wrong. It's never 51-49. And so the concept that I have to fight to retain control. So this means, if I get pre-money valuation of $3 million versus pre-money valuation of $2 million, my share is going to be 10% versus 7% or something like that, right? And at the end of the day, I'll tell you, my experience is you're either going to make so much money that you never dreamed you could make so much money, or you're going to lose everything. There's nothing in between. So does it matter if you own 8% of Google or 7% of Google or 6% of Google? Well, yes, mathematically, those could be hundreds of millions of dollars or billions of dollars, those percentage points. But you know what? When Larry and Sergey started Google, they had no concept that it would be worth $500 billion, right? And so if you fought for that 1%, well, let me put it to you this way. If the outcome of your company, well, let me say this, back up even more. If you are going to be happy or not based on whether you own 10% of a company or 8% of the company, probably the company has failed. If it comes down to 2 percentage points really makes the difference between you happy or not, it probably was a failure. The company is either going to be worth $200 million, so you made $20 million, or you made $16 million. But the difference between 16 million and 20 million in terms of your happiness, your lifestyle, is negligible. Most likely, you're going to be worth $0 million, honestly. Okay, so don't sweat trying to retain control. Instead, rather than trying to own 10% of a pie instead of 8% of a pie, what you should try to do is make a bigger pie. It is not the percentage you own of the pie, it is the size of the pie. Right? It is much better to own 1% of Google than 20% of Webvan. All right, so pick your battles. Pick your battles. Your battle should be about making the pie bigger, about making the per share price higher, not owning more shares. Number 8. Number 8 is many entrepreneurs, they believe that patents are the key to defensibility. Again, I have to confess ignorance. I don't know how it works in France in terms of patenting or the European Union. But in America, many naive entrepreneurs say, well, the reason why we're defensible is we filed a patent. Nothing could be further from the truth. In America, it takes about 10 years to get a patent, 10 years and $10,000. The probability of your company still being around in 10 years is low. And even if you are around, the probability that you have the time and money to litigate a patent as your defensibility strategy is pretty low. What makes a company defensible is that it succeeded. Now, I'm not saying you shouldn't file a patent because someday if you are acquired, it may be valuable. It is also, I think, a very good thing for your parents because then your parents get to say, my son or my daughter has a patent. That's, that's worth 10 grand. But if you think that you're going to patent something and therefore Microsoft can't step all over you, or Google can't step all over you, or Yahoo, or Cisco, or Apple, or you're deluding yourself. At least in America, I don't know. Maybe here it's better. But whenever you read these stories that Microsoft got sued for stepping on a patent and they had to pay a company $60 million, The reason why you read about that is because that hardly ever happens. It's news. Suffice it to say that in your PowerPoint pitch, if you say that, here's our possible ways for liquidity. One is acquisition, two is IPO, third is we're going to sue a large brand who has infringed on our patent and win. Trust me, you will not get funded. Okay, that is just not the plan. So what you do, the way you succeed in defensibility is you succeed. You succeed. File the patent. God bless you. Spend a day with your lawyer. Spend 10 grand, whatever. God bless you. Do that. But really, focus on success. Focus on making your company scale. That's the way you succeed. Number 9. Number 9 is to hire in your own image, which means engineers hire engineers. White people hire white people. Nerds hire nerds. Geek hire geeks. Like that. And really, what you need in a company is pretty simple. I mean, you need one person to make the product, and you need one person to sell the product. The third person should be adult supervision to collect the money. So an ideal startup has roughly 3 people: somebody to make it, somebody to sell it, somebody to keep the kids and the inmates in prison. All right. So that's basically 3 things: one adult, one engineer, one salesperson. That's it. That's it. And even that may be excessive, because you could do it with 2 people, which is why you hear about Steve Jobs and Steve Wozniak. Wozniak makes it, Steve sells it. Selling, making. That's all there is to it. So when you do this, like if Steve Wozniak hired a marketing and salesperson who was just like him, an engineer, we would not be talking about Apple today. Trust me when I tell you. Flip side is, if Steve Jobs hired someone just as full of shit as him to develop the engineering, Apple would have never shipped. He needed a Woz, and Woz needed a Jobs. And so don't hire in your own image. You should hire people who complement you, right? So if you're really good in finance, get somebody good in engineering. If you're good in engineering, get somebody good in sales. But hire people who complement you, not duplicate you. This is a very, very challenging thing, because in particular, engineers love to hire engineers, because engineers think that engineering is the purest form of knowledge, right? And so, so if you're an engineer, you think, oh God, sales is easy, finance is easy, operations is easy, everything else is easy. What we do is engineering. That's the hard stuff. So let's hire really bright engineers, and then we can always turn them into marketing people. That dog don't hunt, okay? Just hire people who complement your skills. Number 10 is to think that you should befriend your investors. I have to tell you that I meet with many, many entrepreneurs after they've gotten their first round. And the story goes like this. We just closed our round, and we really like our investors. Those investors said that they're investing in us. They invest in people. They don't invest in markets. They don't invest in technologies. They believe in us. They're going to stand by us. And, I've heard stories that most VCs are assholes, but not these. We see eye to eye. They understand me. They're going to be loyal to me. We're going to play golf together. We're going to ride in their Mercedes. We're going to go in their yachts together. They really like us, okay? You're trying to befriend your investor. That is a big mistake. Like I said, this is a crack dealer you're trying to befriend, okay? They want you to take drugs. They want you to be addicted. They want to cash out with you. So what you need to do is to maintain an arm's length transaction, and the best way to do this is to exceed expectations, going back to sales, fixes, everything. So what you like to do is have, in a sense, benign neglect. You want your investors to leave you alone. You want your investors that when you need their help, you contact them and they help you, but you don't want them looking down your throat all the time. And the way you do this is you exceed expectation. Now, there's 2 ways to exceed expectations. Number 1, I don't know if there's, this probably does not translate, but the concept in America is called sandbagging. I don't know where the concept came from, but sandbagging means if you think you're going to do 10 million in a year, tell people you're going to do 8. Okay? Put a number out there that you are 90% sure you're going to hit. So if you think you're going to do 10, say 8. Because it is much better to do 8 having said 8 than to do 8 having said 10. Because if you said 10 and you do 8, you are a freaking failure. You came in 20% under what you said you would. If you said 8 and you do 8, you're a hero because nobody ever comes through. If you said 8 and you do 9, you are a freaking hero too. You're like, wow, this is the only company in our portfolio that forecasted 8 and came in at 9. Holy cow. If you forecasted 10 and came in at 9, same 9 million, same 9 million. But you forecasted 10, you came in at 9, you are a loser, right? You did not meet your forecast. So the key is sandbag your forecasts. Now, there's a limit to sandbagging your forecast. You can't exactly say 1 million because at 1 million, you might not be interested enough to get an investment. So whatever your, take this reasonable number and back off, I would say 20%. Just put it in a place where you are really 90% certain you're going to hit the number. So exceed expectations. You should underpromise and overdeliver. And this is the 10th mistake. And I give this speech so seldom, I forget what the next slide is. It could actually be the last slide. Sometimes I have an 11th slide. I can't remember in this presentation. And it is the last slide. So there you go, the top 10 mistakes of entrepreneurs. So thank you very much. So now it's 9:45. My flight leaves Friday morning at 10 o'clock. So I have from now till Friday morning at 10 o'clock to answer questions for you. Although we're going to the Louvre tonight, right? Is tonight the Louvre night? And tomorrow, where are we going? Did you hear that? That's where I'm going. Like, because in America, there's this TV show called Andrew Zimmern, and he goes, and it's called Bizarre Foods. So he goes all over the world to bizarre foods, like all over the world. And one was about Paris, and he went to this market that opens up at 4 a.m. or something. And said, tomorrow morning I'm going to go do that, and I'm going to see how French chefs. I was thinking about this. It's kind of off topic. So let's say you're a chef in France, all right? So people here, they dine really late, right? You eat dinner at 10 p.m., right? So 10 p.m., you're done at dinner at 1 a.m. This market opens up at 4 a.m. So if you're a chef, does this mean that you cook all night? You finally get off work at 1 a.m. and then you have to go buy stuff at 4 a.m. So you sleep 3 hours. Is that what it's like to be a chef in France? Yeah? That's why you should stay in school and be a programmer. Yeah. Wow. So when do you sleep if you're a chef? Oh. Okay. Well, that's my big adventure for tomorrow. I can't wait to do that. So questions? Mike.
Was the first one is the hardest?
Hello, Guy. Well, thank you to be there. I think everyone here has read or is about to read The Art of the Start, so, well, thank you for being in Paris. I have a question. You talked earlier, at the beginning of your presentation, you talked about prototyping. I have a startup right now which is working. I mean, we've been around for more than a year, so we get how it works. And at the beginning of our startup, I think we made a mistake, but I would like to have your take on this. We tried to build a community of early users, and it was very hard to focus on everyone, to build the product. So what would you recommend to people starting from idea to prototype? How would you recommend to handle this first stage of trying to get your first users,
I don't think there's any right answer to this, because a lot of it is just luck, and it's just the law of big numbers. You have to try a lot of things. So, my recommendation is that you remain flexible. So here's the kind of, this is why entrepreneurship is so hard, right? So on the one hand, I can tell you remain flexible, pivot. When you see different needs, change your business model. On the other hand, for every time a company pivots and succeeds, I can also tell you a time where a company stayed true to its vision despite early negative signs and succeeded. So depending on which business book you read, you'll have totally different recommendation. I wish I could tell you the answer. One answer I would give you is not that it's infallible, but one of the best ways to decide on this is to build the product that you would like to use. Now, you might say, well, that's kind of dangerous because if we build the product that I want to use, what if nobody else is like me? So I'm building it for a market of one. That is a danger of that. But, when I look at most major tech successes, that's kind of what happened. Like Wozniak was not building a computer based on a forecast from IDG or IDC or Accenture or McKinsey for personal computers. Wozniak was building a personal computer that Wozniak wanted to use. Thank God there were more people than Wozniak who wanted to use that computer, right? And so I think that's the richest vein. It's not infallible, but that's a rich vein. So one interesting question is, what if you start a company and you find yourself building a product that you can't stand? That's tough. That's tough because it takes so much passion and so much reality distortion and so much denial of negativity and naysaying that it's so much harder if you don't believe in what you're doing. So my recommendation is you build a product that you want to use yourself, and you just hope that there are other people like you. That's the best advice I could give you. By the way, if you are reading or going to read Art of the Start, I'm going to revise that book. That book is 10 years old. And so, for example, there's nothing in that book about crowdfunding. There's nothing in that book about social media. So I'm going to fix that book. I'm going to fix that book this year. And I think I'm going to do and I'll answer as if in an email personally. So I'm going to change the format. I actually, using social media, I have a website where I ask people what you would like me to cover in the revision of Art of the Start. And I sent this out to my social media channels, and I now have 600 questions in that database. So I hope a lot of them are duplicates because it's a lot of questions to answer. But the Art of the Start is going to be revised. Yes.
Thank you.
Yes.
Do you have any take on this?
Yes.
The pros, the cons,
Yes.
etc.
I love the concept of crowdfunding. I love the concept of crowdfunding because I think it is much more accurate to gauge consumer interests via crowdfunding than via venture capital investment. That in a sense, a venture capital investment is taken as a proxy for the possibility of the success of your company. But venture capital investment is a poor proxy because venture capitalists are wrong, 9 times out of 10. So I think it's much more, it's much better data. If you can pre-sell an iPhone case, or I don't know, I'm using whatever. I advise a company that makes a little gizmo that you plug into your electric outlet that uses low power Bluetooth. So with your Bluetooth phone, you can control the outlet. Also, because it's low power, you pair it to your phone. So when you enter the room, you can program it so when you enter in the room, it knows you have your phone, so turn on the light. That kind of thing. So that's perfect for a Kickstarter kind of program, right? So, if you were trying to convince a venture capitalist to invest in that company, it would take you 9 months. You'd have to prove why it's better than something that Belkin is doing, or it's better than something that, somebody in Taiwan could knock off. But if you put it on Kickstarter, and you get 1,000 people to buy it at $50 each, that's $50,000. It's much easier to raise $50,000 that way, and it's real proof. I mean, you've really convinced people to buy it as opposed to a rich venture capitalist who's driving around in his Mercedes playing golf 3 days a week that they should invest in it. I think it's much better data. So I love the crowdfunding concept. And I gave you this list of all the reasons why it takes a lot less money to start a company. So now, if you could raise $50,000 or $100,000, you can start a company, right? And you'll be doing it without dilution because you're not selling equity. What you're doing is you are pre-selling your product. So it has the added benefit of real data that people are willing to buy your product. It's non-dilutive, and you don't get pain in the ass shareholders. Man, like, what's wrong with this equation? It's faster, it's easier, it's better. Now, I mean, it's not a complete solution, but and I'm not saying everybody's going to be a Pebble and raise $10 million. Okay, that's not true either. But $100,000 goes a long way for most tech startups these days. So I really love the concept of crowdfunding. Who's got the mic? Yeah.
Hi guys, such an honor to have you with us today, this morning in Paris, and you made such an insightful presentation, really loved it. I am Kempire, so we basically help refugees become entrepreneurs to transform refugee camps from being dependent entities into being independent, creating an economy. One thing I was perhaps expecting you share something with us was the issue of vesting. How do you share your company with your co-founders? Okay, you must not retain most of your company when we talk about investors, but how do you share, this piece of cake in the beginning with your co-founders?
Okay, so conceptually, there's several principles in play, right? So one is you shouldn't spend a whole lot of time negotiating with your co-founders because, again, you're either going to own 8 or 10% of something huge, or it's going to be worthless. So don't aggravate yourself about what percentage you own. Aggravate yourself about creating a great prototype. That's principle number one. Principle number two is, although at the moment you start your company, you all swear that this is the greatest thing, you love it, you're going to dedicate your life to it, you can't see working any other place for the rest of your life, it's just not going to be true, right? So in a sense, you kind of need a prenuptial. And the way a prenuptial works in this is you all have to say that we are going to vest our stock. And even though you are the founders and you know you're going to stay with this company for the rest of your life, you still vest. And vesting means it takes 4 years to get all the stock. There's a 1-year cliff, so you don't stay at least a year. You lose the stock. Put all that in place for everybody. And the reason why you do this is because 6 months from now, when the other founder decides that this is not his life or her life call, then you say, okay, well, hallelujah, you quit. You haven't reached a 1-year cliff. You don't have any stock. Aloha oi. Have a happy rest of your life, right? Now, if you had 6 months earlier said, okay, we really believe in you. Here's your 10% now, forever. Here's your 10% now, forever. Here's your 10% now, forever. 6 months from then, the person quits and still keeps the 10%. What are you going to do? Two bad things. So one is you have 10% less of the company to share with others. So you've used some of your currency that you could use now to recruit the replacement, for example, right? And the other thing is that a sophisticated investor, when they look at your capital structure, will say, well, what happened to Joe? Joe was a co-founder. Joe was with you for 6 months. Joe quit, and I see Joe still has 10% of the company. And you're going to say, well, when we started the company, we thought we would all be here forever. We all contributed together, so we all got 10% right out the gate, no vesting. And your investor will maybe not say it to you, but think, this person is stupid. This person didn't listen to some adult's advice to vest. This person is clueless. Do I want to invest in a stupid person who would give 10% of the company to a founder, assuming the founder would be there forever? This does not help you get an investment when your investor thinks you're stupid. So it has all these kinds of ramifications. Generally speaking, CEO, founding CEO, 10 to 15%. Founding VPs, 8 to 10%. It's something like that. It could be higher, it could be lower. It's something like that. It's not 90% CEO. It's not 0.9% either. It's 15%. It's something like that. Um, and that's kind of roughly the, you know, roughly the parameters you should be working at. Oh, one more piece of advice is don't have title inflation, right? So you have to name a CEO, just well, in America anyway, you have to name a CEO for legal structure. But do you have to, just because the person you were drunk with that weekend that you started the company, that doesn't make him or her CTO, okay? Because someday you may have to hire a real adult to be CTO, or you may have to hire a real adult to be VP of engineering. So don't throw those titles around so loosely. Just because you got drunk with that person on the weekend and you're CEO, that doesn't mean, well, you got to make him happy too. He should be CTO or CMO or CFO or CIO or C whatever. You know, you should throw these titles around very, very carefully, because if you are two guys in a garage, two gals in a garage, and you know you're CEO for the legal work, and so now he's, God, you know, I'm CEO, and you know, we were drunk together that weekend when we thought of this idea to sell dog food online. So, you know, since he's the programmer and I'm the sales guy and I'm the CEO, I'm going to make him the CTO, right? And then God forbid you're actually successful, and now you say, huh, you know, my drunken buddy from that night where we decided to start this pets.com, he ain't that great a programmer. He's never written a program in his life. He's never really finished a website in his life. You know, he was in Intro to PHP when I met him, and we got drunk, right? So now, but I've already named this loser CTO. So now, what do I tell the adult who really understands PHP program? What do I call him? You know, chief technical officer, super chief technical officer. You know, what? I'm at the top of title inflation already. So. Take it easy with the titles also, not just the equity. What else?
Good morning. I'm the founder of startup that is now featured on Kickstarter. So we are on the staff picks, but I know it's not going to be a pebble because first it's in food industry, and second it's we don't have enough traffic, I think. But my question was about pre-money valuation.
Yeah.
How can we like the sales you're making on Kickstarter? How can you use it with your investor, where like for pitching angels and other VCs? Thank you.
Are you all MBAs or getting MBAs? How many of you have an MBA? Because I won't offend that many people. I have an MBA too. Okay. So what I tell people in America anyway. See, I have to like couch these answers with what happens in America because I don't know, you know, what happens here. But in America, pre-money valuation of a tech startup, every full-time engineer is worth roughly $500,000. Every full-time MBA, you subtract $250,000. So if you're an MBA with an engineering degree, you net out as being worth $250,000. So now people laugh at that, they think that's funny and all that, but you know, if you look at the pre-money valuation of tech startups, it's roughly $500,000 per engineer. The pre-money valuation is a very tricky thing because it is truly a market, but it is a very inefficient market. It's not like the stock market where you can call up a broker and get a quote, right? So this is like, it kind of depends. I mean, it depends who's asking. If you were to get an investment from, well, in America, the two best venture capitalists are Sequoia and Kleiner Perkins, okay? So if you were to get an investment from Sequoia, and they said, we give you $2 million pre-money valuation, versus another venture capital firm that said, we'll give you $4 million pre-money valuation. Going back to the slide, you'd say, huh, this other company, this other venture capital firm gives us twice the pre-money valuation. This means that instead of ending up with 8% of the company, I would end up with 12% of the company. Let's go with the $4 million valuation. I would argue that taking money from Sequoia or Kleiner Perkins, which has such a history of creating Cisco, Apple, YouTube, you know, down the line, that Kleiner Perkins or Sequoia money at $2 million pre-money valuation is more valuable than, you know, JoeSchmoVC.com at $4 million valuation. You should take the lower valuation. You should have more dilution, thinking that at the end of the day, you may have less percentage of the company, but the pie will be bigger. It's all about the size of the pie, not how much of the pie you own. And so there's so many factors going on in pre-money valuation. The trick is try to never be the first person to name a number. Like, ask the venture capitalist, "Oh, what do you think it's worth?" And then they'll say, "Well, what do you think it's worth?" And just try to just keep. Well, we looked at the comparables in America, and a similar company got $4 million pre-money valuation. I mean, if you can just, it's got to be something like that. It really is. It is a very tricky negotiation. But for sure, in your written document, your PowerPoint pitch, never put a number, because no matter what number you put, it's either going to be so high they're going to think you're stupid, or it's so low they're going to think you're stupid. The odds of hitting it, they hit that number just right. That's exactly what I thought this company would be worth, is 0. Okay, it's 0. So don't put a number out. Try to find comparables. But there's like so many levels of trickiness here. So if you find comparables, then you don't want to find a comparable that's too close to you, because then you're saying, "Oh, look, there's a lot of competition. Somebody does the same thing as us exists," and this. So that's why it's just better to do Kickstarter and not deal with venture capitalists. You don't have to do all these mind games. It really is. What else?
Hi, Guy. To keep on what you were saying about crowdfunding, which is a very good equation and something like a very exciting concept, I'm still wondering, is it really possible, according to you, to build a sexy brand with crowdfunding?
I think that, well, the underlying question you have is, can you build a sexy brand without millions of dollars of venture capital? Right?
Yes, and
And the answer is yes.
by using means of communication which is the same for a lot of people, I mean, it's not very personal.
So the answer is yes. That I think in marketing, too much money is worse than too little. And so I think the key to a brand is a great product. It's not how much money you raise. And in fact, the more money you raise, the worse you'll probably do. I also believe that just because you raise a lot of money doesn't mean you'll create a great brand. So basically, I believe money and branding is inversely related.
But it's not only about how much money you raise, but also about I mean, this way of making your company known, And do you have an example of a strong brand? Because crowdfunding has been existing for several years now. So do you
Well, Pebble is an example, but that is an extreme, right? Because they raised $10 million. So you kind of have to throw that out. I could also challenge you to name a company that raised a lot of money and built a strong brand. Because that's a similar question, right? I don't know the history of enough companies.
I'm not opposing this.
Yeah.
I'm not opposing crowdfunding to raising money from investors.
Well, let me put it to you this way. Not many people have the choice between it. So, like, to conjure a hypothetical situation where you're sitting there with your founder, you say, well, we could raise $10 million from venture capitalists, or we could do crowdfunding. Which do you think we should do? That's just not going to happen, right? I mean, that's like in the book publishing business, very few authors are sitting there saying, we could get Penguin to give us a $5 million advance, or we could self-publish. What should we do? 5 million self-publish, 5 million self-publish. Which should we do? The fact is, you're not going to get $5 million as an advance. You only have self-publishing. So I think it's somewhat of a hypothetical question that just won't come up. God bless you. If you can raise $5 million, go for it. But the odds are low. And it is much higher probability that you'll raise money crowdfunding than you'll raise money with venture capital. You'll raise more with venture capital if you pull it off. But but we're also putting it into a dichotomy where there's either crowdfunding or venture capital, right? So one path is to crowdfund the first 100,000 to get the first 1,000 copies, first prototypes, whatever, sold, and then you demonstrate that it is successful, that the dogs really want to eat the food, and then you go get venture capital. That's really the more realistic path.
Yeah. But well, maybe the difference between venture capital and crowdfunding is that when you raise money with crowdfunding is more raising money for building a product and selling it, because it's about critical mass and stuff like this.
Then
critical mass. I mean, maybe.
Yeah.
Well, I mean, it's you need money to sell, to build and sell, and then sell your product.
Right.
Whereas when you raise money via venture capital, is more to build a company and a brand. There is a bit of a difference here. No.
I understand intellectually what you're saying. I don't agree.
All right.
I think that great companies start because they had great products, not because they had more money and a better vision. I don't think when Steve and Woz started Apple, they said, let's build this most valuable company in the world. They just wanted to make a bunch of motherboards and sell Apple ones. I think that's the genesis of most companies. That even with Microsoft, I don't think Bill Gates sat there and said, someday we're going to have a search engine, we're going to have an Xbox, we're going to have a, operating system, we're going to have word processor, spreadsheet, database. I mean, back then they were just like, shit, these guys from IBM called. They need an operating system. Well, what can we do? I think that's the reality of most tech startups. Now, after the fact, God bless you. If you're the next Bill Gates, tell your story. Say that, even in 2013, you had this grand vision of, creating this company bigger than Facebook and bigger than Google and bigger than Microsoft. And it started, in like December 2013. If you get to that point, hallelujah, you can lie, you can distort reality, you can change history, you can do all that kind of stuff. But like for right now, just build a freaking prototype, okay? We'll figure out reinventing the story later. Okay? What else?
Hi, I'm Pierre. I have a question. Do you think that the bootstrap model is biased towards web companies?
Does the bootstrap model apply to web companies?
Well, the model that you need to bootstrap your product first, do you think it's biased towards building web companies or apps?
Absolutely. I mean, I have a hard time coming up with. Well, I think the bootstrap model doesn't apply to biotech, right?
You think that's
if you're
problem?
going to cure cancer, you're going to need $200 million. Let's face it, right? So you can't like bootstrap and say, oh, we're going to get some spare centrifuges and we're going to find this miracle thing and we're going to go to Brazil and kill some butterflies, squeeze their intestines out and find a cure for cancer. And we're going to bootstrap that. I don't see that happening. And we're going to skip phase 1 because we're going to crowdsource phase 1 testing, right? So I don't see that. But I think for almost every other kind of company, bootstrapping is the way to go. I mean, like this, in a sense, I'm a crack dealer telling you stay off crack. I'm a venture capitalist telling you postpone venture capital, postpone it forever if you can. Not that they're all bad people, just most of them are bad. But don't do it. I mean, and if you're going to do it when you are strong. That when you're saying, for me, the best situation is you come to a venture capitalist and you say, so me and my buddy, working on the weekends, after school, whatever, we created this product that we wanted to use. We created this website that we wanted to use. And lo and behold, we opened it up, and to our utter amazement, hundreds of people started signing up. And then thousands of people started signing up. And then, so first we had on this little server, little French version of Rackspace, and pretty soon they called us up and they said, you're like 50% of our traffic. One company's 50% of it. We cannot handle you anymore, right? So now we had to go to Amazon, and they were like, Amazon now, our bills at Amazon are $10,000 a month. We get like 10 terabytes of data coming in every month, and then one day, my buddy, my partner said, why don't we stick a little thing that says on our website that says, click here to advertise. And we said, okay, why not? Hardly anybody's going to do that. So the next day we come to work, and like 500 emails from people who want to advertise. And they're like, we don't know how to handle that. So we need money to hire people who can do biz dev, and we need somebody who can like understand vastly overrated, because it's very difficult at your stage, truly, to get a totally proven person. It's very unlikely. And so, you know, when Woz and Jobs partnered, neither of them were proven. So don't. All venture capitalists will tell you they want a proven team with proven technology and a proven market. Okay, but if you truly look at the great tech companies, it was an unproven team in an unproven market with an unproven business model. The reason why investors always say they want proven team, proven market, proven whatever, is because investors need to raise money from funds. And so, you know, imagine that you're going to the pension fund of the employees of the French government. And I don't know, I'm making this up, right? So let's say that pension fund has 2 billion francs or 2 billion euros under management. And so you work for a French venture capital firm and you want them to put 20 million euros into your fund. It's very difficult to go to the fund manager and say, well, our investment thesis is we're going to invest in unproven entrepreneurs in unproven markets with unproven technologies. That's a hard sell to get $20 million from the private asset manager of the French government, French employees pension fund. So you have to tell this bullshit story that, yeah, we're going to find proven entrepreneurs with proven business models, with proven technologies. And then some other person on the other side who used to work at Goldman Sachs is going to nod his head and say, yeah, okay, here's 20 million bucks. That's how this game works. But truly, history is made and money is made with unproven teams and unproven markets and unproven products. So you're right in the right space. What else?
Hi, Guy. What would be today the few tech areas where you would actually investigate starting up a company?
That I would start a company?
Yeah.
I would not start a company right now because I'm 59 years old. I have 4 children. My children are 8, 12, 18, and 20. I cannot give enough of myself to my family and a company. So I'm not interested in starting.
If you were our age.
That's a big if. If I were at your age and I knew what I know now, which is already an impossible situation, I would just work for companies that I fell in love with what they're doing. I wouldn't be rational. I wouldn't be like, I mean, honestly, right? Like, who the hell knew that Facebook would be this big? Like, yeah, you can reinvent it, and Zuckerberg could say, yeah, I had this vision for how people wanted to communicate and socialize, but let's just say he's like a dysfunctional guy who couldn't get dates, and he created Facebook, right? That's the real story of Facebook. He didn't have this vision for empowering people to improve their social lives. He was trying to get dates, right? And so that's what I would do. I would just, and knowing that over the course of your career, it used to be that you go to work for, I don't know, Société Générale and for 50 years, and then they give you a watch when you retire, right? But that ain't true anymore, right? So now, so if you're 25, by the time you're 60, you probably will work for 10 or 15 companies. You're not going to work for one company. So what the hell? How wrong could you be? I could build the case if you went to work for a startup and it's the next Google, hallelujah. You're going to be so rich. I could build a case if you work for a company that totally failed, you'd probably learn more from the failure than if you happen to step into the next Google. One of the downsides of going to work for the next Google is it'll be very difficult to separate whether you caused the success of this company or you were just dumb shit lucky. Probably you were dumb shit lucky. But, I don't think most people who are early employees of Google, they're looking at themselves saying, God, I am just dumb shit lucky. I'm so rich now. They're always looking like, I caused the success of Google. So, I think you can pretty much chill out and just do what you love, man. Do you have a mortgage right now? No, right? Do you even own a car? No. You have kids? No, right? So, what the hell? I mean, Now's the time to screw up, man. I mean, when you're my age, you cannot screw up anymore. I got 4 freaking mouths to feed every day, right? 3 of them are in private school. 1 is in college. I spend on education a year.
Life is unfair.
Yeah, well, life isn't fair. I spend on education probably $140,000 a year for all my kids. That's the odds of that's a lot of books. I need you guys to buy books. Okay, right after this, I want you all to buy books. Right, right. But I'm not trying to make you feel sorry for me, right? I'm just telling you that I have I have a different perspective now.
Just in terms of sectors, what do you think the best innovation
Okay,
would
just
come
let me provide an analysis of what just happened. How old are you?
28.
Okay, so you're a 28-year-old person, and you're asking a 59-year-old person with 4 kids what sector I think is important. Can you see where I'm going with this? You are asking the wrong person. Well, what if I told you it's enterprise software for shrimp farming? I see that as a huge market. You know, there's like shrimp farming, it's ecological, it's a high source of protein, much more efficient. They don't emit methane gas like cows, so it's not contributing to global warming. You just get 1% of the shrimp farming software market. Do you know how significant that would be? Well, you're thinking, I don't give a shit about shrimp. I don't like shrimp, you know, so don't do shrimp. So I think, I don't mean to blow you off or anything, but you know, a 28-year-old kid should not be asking a 59-year-old man what's going to be hot. I have no freaking clue. I want to know what you think is going to be hot. Like, did I think Vine was going to be hot? No. Did I think Snapchat would be hot? No. Twitter? No. I don't have no clue. So why are you asking me? I mean, you know, you're impugning your own intelligence. You should be telling me, not asking me. So does that answer your question?
Yeah, but I don't want to buy your book anymore.
Probably never had speakers like this before, huh? Louis L'Amour could not do this, what I just did. What else? I don't want to turn you all off to entrepreneurship, but seriously? Really? If you get 1% of the breakdancers.
And I saw one day you post, because I follow you on Facebook and social networks, and I saw you post, I don't remember if really it was you. Yeah, really?
I can guarantee you it wasn't me.
But you post a video on 8 years old kid doing breakdance.
Yeah.
Yes.
Yeah.
It was it. It was you. Yeah. And I like to see the what other people which are not in the community, or maybe you are.
No.
Think about breakdancing, but just I want to know what you think about that.
I don't know a thing about breakdancing.
Yeah.
You know, like my social media platform strategy is I find interesting stuff and I post it. And it could be breakdancing today. It could be, you know, if I find a great video about this market that I'm going to tomorrow morning at 4 a.m., I would post that too. So I don't have anything against breakdancing, but I'm just looking for interesting stuff. My strategy with social media is to find the most interesting stuff I can so that people reshare, retweet, repost what I do so that I get broader exposure to more people so I get more followers. I'm always trying to get more followers. You know how social media experts say you shouldn't worry about the quantity of followers, you should worry about the quality of your followers and the engagement? I think that's total bullshit. I want as many followers as I can. Okay, so there's only 2 kinds of people in social media. Those people who want more followers and those people who are lying.
Okay, but so so you're just saying that it was interesting.
Yeah.
Yes.
That's what I'm saying.
Okay.
Yeah.
I have another question.
Yeah.
My question this time it's about Snapchat, because in their business model that they are not making money from their business.
Yeah.
So how did they raise money from investors, and how the value of the company is about 3 or 4 billion dollars
I mean,
today?
there is a path that says you build something so viral, so that's so rapidly building up a user base that you can go to a venture capitalist and say, all right, so we're adding 1 million people a month, and that's accelerating. And a venture capitalist will say, so we forecast that you'll have 75 million members by the end of year one. We'll figure out a way to monetize 75 million people. So that is one path. That is a high risk strategy, though, because if you don't deliver 75 million users, you're not interesting, right? So it can be done, and I mean, Snapchat did it, arguably Facebook did it, Twitter did it, but the other path, well, I guess one lesson is there is no single path to success, right? So another path is that you bootstrap, you charge people for it, you have a freemium model, whatever. You have nowhere close to 75 million users, but you have 250,000 people who are paying you $10 a month. It's not a bad model either, right? That's very different from Snapchat. So the message here is that there's no single path. There is no right or wrong. There's only what works for you and what doesn't work for you. Everything I said today, you could do the opposite, succeed. Hallelujah. I hope you do. I'm just telling you what I think. And I hope you prove me wrong. Nothing would make me happier than you prove me wrong. So, what else?
Hi. Regarding viral social media and website, what would be impressive numbers after 6 or 1 year on be around for a social media platform?
For social media platform,
social media and content.
Yeah, after 1 year.
After 6 and 1 year.
5 million. 5 million. If you showed up and said, so we have, Les Snapchat, and we have 5 million users, we've been around for a year, that would definitely create attention. Yes, yes. I think the magic number is 5. For a play like that, 5 million. Okay, what else? Yes. Yeah. Okay. Well, this is a very hard question to answer because, well, first of all, I'm not your psychiatrist. I don't know the answer. I mean, I could build the case that if multiple companies are doing the same thing, none of which have been successful, the market is telling you something. I could also build the case that you should gut it out because, you might be the right one. There's no way to tell. This is something Silicon Valley is very good at doing, which is after the fact, we know how to declare success. Really. And if you ask a venture capitalist, why did you invest in this deal? And the deal was successful. I mean, there was liquidity. Okay, I will take an extreme example. So let's suppose that you invested in Twitter. Okay. So now after the fact, you say, of course I knew Twitter was going to be successful. Social media was on the rise. People needed a quick way to communicate. They wanted a way to democratize information. I looked at the team. This team had already worked together in a previous company. They understood the technology issues. Of course, Twitter was a success. It's because of my insights into the market, into human behavior, into picking teams, into establishing business models. I knew that brands would want to have promoted tweets at the top of people's feeds. Okay? If Twitter failed, the same person would have said, my partners did that deal. I told them not to do that deal. I told them there was already text messaging, there was IRC. Why would you invest in a dumbass idea like Twitter? Okay. That's how it is in Silicon Valley. So the thing is, it's very difficult at the time you need to invest in Twitter to figure out, 10 years from now, am I going to be telling story A about how I knew this would be successful, or am I going to be telling story B where I'm blaming my partners in my firm who did this dumbass deal, not me? Because the same people who invested in Twitter and Facebook and Cisco and Yahoo and Apple also invested in Webvan. Like today, okay, have you heard of Webvan? Okay, so Webvan is this company started in Silicon Valley. Their vision was people were so busy, they didn't want to get in their cars, they didn't want to drive to Safeway to buy groceries. So you would go online to Webvan, you'd say, I want broccoli, I want celery, I want some tomato sauce, I want some, caviar, I want some, I don't know, cheese. And then the automatically picks in this factory, goes into a van, the van is optimized for delivery, and it drops it off at your house for $5 handling charge, right? So nobody has to go to Safeway anymore. About $400 million was invested in that company. It had a proven team. Louis Borders, the founder of Borders Bookstore, truly understands retailing, right? Started Borders Bookstore. Proven team, proven market. Everybody's buying broccoli. Like everybody has to eat. Everybody, you can get. This is even better than dog food. Only 1 out of 4 Americans own a dog, but everybody eats food, so everybody goes to a market. So it's 100% market share, total addressable market, 300 million people, man. How hard could this be? And they eat every day. This is not B2B. This is, C2C kind of business, right? So $400 million goes into that business, and it is totally gone because apparently people don't want to spend $5 to get broccoli delivered to their house. But, we could be sitting here today. If Webvan had been successful, we could be sitting here today saying, God, that is so obvious that it would be successful. They had Louis freaking Borders, the founder of Borders Bookstore, as a CEO. Everybody has to eat. You could automate a factory. You don't need people picking up the broccoli. You just tell the computer, send this little robot around, get the broccoli, get the pasta, get the milk, get the tomato sauce, deliver it. It's so obvious why Webvan would be successful. And Amazon is gone now. Of course Amazon is gone now. What would people buy online? They'd only buy books, they'd buy CDs, they'd buy DVDs, but they wouldn't buy shoes, right? Like what woman would buy shoes without seeing the shoe and trying them on? Go ask a French woman, would you buy a shoe without seeing it or trying it on? I don't think so, right? So of course Amazon is a failure. They're focused on a stupid niche of only books. How many people read books anymore? How many people get books delivered anymore? Nobody. It's all electronic. Amazon is gone, but Webvan is the dominant e-commerce retailer in the world. Okay, we're not having that discussion today, right? It's quite the opposite. Webvan is gone, and Amazon is the dominant e-commerce force in the world. And why is that? The question I'm asking is, could you have made that decision at the moment you met Jeff Bezos and at the moment you met Louis Borders? Louis, you are doomed to failure. We could put $400 million into you and people will not buy groceries online. You cannot deliver this in a scalable manner. Jeff, we believe in you. Right now you're selling books and DVDs, but someday, Jeff, people will buy cars from you. They buy printers from you. They'll buy electronic books from you. They buy tablets from you. They'll buy everything made from you. And if you're not shipping it, Jeff, from your factory in Seattle, then you'll have partnerships. The bad word, partnerships, right? And you'll have people who they will never ship their barbecue to your Seattle warehouse. You'll simply sell the barbecue on the Amazon.com website. They will ship it direct, and you will make 5% just for bringing the buyer to Amazon.com to buy the barbecue from me. Okay? That's life. I don't know how to explain it any better. So I cannot answer your question. You could be Jeff Bezos, or you could be Louis Borders, who incidentally is a friend of mine. So I don't know. I don't know. I'm sorry. I wish I could help you. Yes.
Hi, Guy. My name is Francois, CEO at myhappy.com, and I live in California too.
Okay.
So I have a question to you. Might be a question from Lake Lemer. So a leader just died a few days ago, Nelson Mandela. A leader just died a few days ago. What do you think young entrepreneurs can learn from his life, And do you think that dying for and fighting for your own ideas every day is worth it?
Jeez. I don't even know how to begin to answer that. I mean, wow. I think Nelson Mandela is so far above entrepreneurship. I mean, he's like, you know, I do. I mean, he operated at a higher level, a higher sense of, you know, responsibility and just goodness in the world. And hard to compare Nelson Mandela and Mark Zuckerberg, for example. You know what I'm saying? So, wow, he's in a different league. He certainly, you know, would I advocate going to prison 30 years for your startup? Yeah, hard to make that case. Wow, I have to punt on that question. I just.
let's go deeper. Those guys,
yeah, why don't we?
They're going to fight every day. They don't have any money in their bank account. Their wife going to tell them, stop doing your startup, work for a great company in France. You know, in France, kind of, don't do your startup, just work for a big company. So they're fighting every day. Okay, they don't go to jail, but it's hard for them. So it's kind of hard anyway, even if it's not like going to jail. That's just the point.
And so what's the question?
So don't you think that we can learn something from Nelson Mandela life? That was my question for entrepreneurs every day. But if you don't think so, that's fine.
Well, you know, certainly it's hard to point to an example of an entrepreneur who succeeded without persevering, right? I mean, you know, like Steve got fired from Apple, right? And, you know, Next failed. So I don't know of many people who just, you know, everything they did was successful and they took off like a rocket. It's just, after the fact, you can sort of position yourself that way, that you did everything right in your career. But I think that's hardly ever the case. So it is, you know, perseverance counts for a great deal in entrepreneurship. Okay. What else? Got a lot of questions in this audience. I can never.
Hi, guy.
1 hour Q&A. Yeah.
I'm Monica. I live in California. Did UCSC and right now finishing SEC. When I got back to France, it was kind of hard to readapt here. And last year, you were here maybe with Microsoft BizPark. How do you see that? I'm not French, but I'm asking the question as a French person. How do you think France is evolving, and what do you think would be the next step?
Well, you know, I mean, I spend 2 days a year in France, so I really.
From what you saw last year and what you're seeing today.
Well, I tell you, you know, I go all over the world and make presentations like this, and from Moscow to Buenos Aires to Sao Paulo to, you know, just like everywhere around the world, and you people are more similar than you are different. I mean, it really is a flat world. I enjoy meeting young people with, you know, who view the world as just full of potential. I mean, it's just true, whether you're in France or South America or America. This is a beautiful place. I mean, it's a great thing. It's one of the beauties of the democratization of technology. It enables people like this to start. It's a great thing. And you know, if I didn't hear what you said, or you know, make judgments by your accent or your, you know, knowing where I am, I don't think, if you just took me and just placed me in an audience like this and wiped out people's accents, I could not tell you where I was in the world, really. Now, maybe Singapore, because Singapore is always saying, yeah, we want to come and study your model. But other than that, I could not tell where I was in the world, really. What else?
This is a little bit linked to the previous question, but suppose you're in a city like Paris, in a country like France, you want to foster entrepreneurial success, like in Silicon Valley.
Yeah.
What is the one idea you should import from Silicon Valley, and what is the one idea you should not import from Silicon Valley?
So I think the most important thing you could do is to support the schools of engineering of your colleges. The core of Silicon Valley is the engineering school of Stanford. And so I don't know about the engineering schools here, but I think that's the key.
Pretty good.
Yeah. So
supposedly
Polytechnique. Yeah. So I think that is the key. One thing I would not suggest you do is focus on making capital easily accessible to entrepreneurs. That I think many organizations or many government institutions, they look at Silicon Valley, they say, okay, so what does Silicon Valley have that we don't have? And one obvious thing is they don't have a venture capital community. So they say, well, we need to create venture capital because entrepreneurs need money. I think that worked in Israel, but I don't think it worked anywhere else. And especially now, where for the reasons I mentioned before, there's a lot less need for capital, that I would not focus on capital. I would focus on engineering schools. That's the key. If you have great engineering schools and you'll have great engineering students, I think great engineering students by definition are always trying to create a better world, a better gizmo, a better website, a better gadget, a better something. So if you have great engineering schools that create great engineering students who create great ideas, the venture capitalists will come. They will come. Because the one thing you can depend about venture capitalists is that they are greedy. So when they see opportunity, they will come. You don't have to make them come. So that would be my advice.
Thank you. One question. I'm currently launching a B2C learning platform. I'm a biz guy, and I'm the only the unique founder in the company who asking web agency to develop it. In a let's say short or middle term, is it possible to continue with a web agency? You think we have to hire a CTO or even find a CTO as a co-founder, or is there like a huge difference for you in the industry things?
This is it's a hard question to answer. I mean, truly, it depends on the core value of your company, right? So there are companies where you literally are inventing things. I mean, you literally are inventing algorithms. You're inventing ways that your core competency has to be technology. There are other companies that the core competency is marketing or sales or other things like that. So it would just so truly depend on your particular situation. I don't think I can answer that question either. I mean, it's hard to say. It's hard to imagine that over the long run you can outsource your CTO though.
And even if the company is more focused on e-learning, so like education, but since it's a pure web company, the CTO, like the
I don't know.
gotta be inside.
I just think that to truly do that in a revolutionary, innovative way, you're going to need a CTO who lives and breathes and dies your company. I don't. I mean, it's like saying you want to create a world-class restaurant, but can we just, rent the chef every once in a while? I don't think so.
And is there such a huge difference between hiring a CTO and having a CTO as a co-founder?
Not really. I mean, it's not always the case that a co-founder is a CTO. So I think that's a difference of slight degrees and short time periods. I don't think it's a huge. Steve Wozniak was a founder and CTO, right? Would it have mattered if they found Wozniak 6 months later? Probably not. Not over the course of the lifetime of Apple. So I don't think so.
But it's important to make him a co-founder, like giving a sufficient amount of shares.
It depends on how you pose the question, right? So the answer is not to make him a co-founder. The answer is to find someone who is a co-founder. It's a very big difference. So one is like you say, okay, so we're gonna make you a co-founder. We're gonna force you into believing. We're gonna buy you. The other is evangelism, where you're sharing the good news and you believe in what we're doing as much as we do. That's what you want with a co-founder. Okay? Okay. Okay.
Hi, guy. Okay, last question. You talk about the relationship with investors, and actually, Silicon Valley has a lot of money compared to other countries. So I would like to know what is your advice for entrepreneurs, where to look for the money? I mean, is it good, even if we stay in Paris, to look for the money in Silicon Valley, for example, or in the UK, or is it better to have the VCs or the investors close?
I think it's usually better to have the VCs close. Having said that, you may come from an area. I'm not saying Paris is, but you may, or somebody may come from an area that is not open to this kind of investment. It would be very hard to get a Silicon Valley investor interested in a French company because it is 12 hours away, 9 time zones. I have no idea about the corporate finance laws of France. I don't know if you can offer options or not. I don't know if there's an IPO market here or not. I don't know if there is an IPO market, how does tax work? I mean, there's so many things. On the other hand, if you said, well, it's me and a bunch of guys from Polytechnique, and we're like the world's greatest programmers, and those guys want to live in France, so we're going to have our development team in France, but we're going to incorporate a Delaware corporation, and we're going to have our headquarters in Silicon Valley. Why not? I don't care where the programmers are. So that could work. But to say, our board meetings will be in France once a month, and here's the name of our French lawyer, and he'll explain to you corporate structure in France. Well, that's just, you're putting a lot of speed bumps in front of people that way. So, yeah. I have one more thing to tell you. My latest book is a book called Ape, Author, Publisher, Entrepreneur. It explains how to self-publish a book. So if any of you are interested, that is a card, and I'm going to give that to you as a gift. That if you're thinking of writing a book, you can take a card. It's a promo code for the book. But that is my gift from me to you. If you ever consider writing a book, this book will help you do it. And then after this, I'm going to be over there, and we're going to actually sell you the books. This book it's about authoring. It's about writing. So I'm going to give you that. But the books that explain how to create a company, we're going to sell you that over there. Okay, so there's a difference. And they're in French, so, And I wrote a book called Enchantment, which explains how to influence and persuade people, which, trust me when I tell you, every entrepreneur needs to be able to enchant people. And I would say the French version of that book is the most beautiful version because it has color pictures. It's truly a beautiful book. So with that, thank you very much. I've enjoyed talking to you. Thank you.